Dave.
Hi, Josh.
Java with Josh.
Episode 5. Oh.
Let's see. I just want to get up here and talk, and you're about all of this creative stuff. You want, fancy signs and all that fun stuff. So
Yeah.
I hope you enjoyed that, because I'm not so sure so many of the people watching enjoy that. But as Dave likes to say, his role here is to humanize me.
Mm-hmm. And bring the fun.
So I hope you do that. Welcome to episode 5. I can't believe it's episode 5 of Java with Josh.
That it is, my friend.
I am Josh. This is my good friend David Michael.
Hola.
Actually, we got made fun of this morning because I call you David too often, so I will try and stop that.
And Michael referred to me as David, and he was quite embarrassed. That's my birth name. I like that name. It's all good. It's all good. This is exciting, Josh. Look at that beautiful sign behind us. Why don't you talk about that? That's a long time coming right there.
It is. So we've spent a lot of time trying to build out something we can feel proud of as we sit in front of it. And we have these bookshelves which sit pretty empty. So if you bring something into our office and for us to put in the bookshelves, we'll gladly do it. But finding a piece of artwork to put back there was really difficult.
Yeah.
So we said, well, let's put a sign up there. And we named it after our retirement planning process, the Own Your Retirement Planning process that we're going to talk about here in a second. And we said, let's put some neon. Neon. Everyone loves neon.
Neon's the coolest.
Oh.
You can kind of see in the shadows Brian trying to get that glare out of the windows. This is new. We're trying to make things look really pretty here for you. So that is our
things
chief compliance officer.
Only the person who went to art school notices.
Yeah,
so
that's a good point. Josh, I see something here about the sale of your childhood home.
My parents have lived in the same house since I was in 6th grade, maybe 5th grade even. And 31 years now. Today, there are moving trucks as we speak at their house. They are officially moving out. And the picture that you had up there was from Sunday night. We had one last big family dinner at my parents' house with all the kids running around the backyard, and we said, let's take a picture of the 5 of us in front of the house, and it's kind of a bittersweet moment. And I was thinking about this, and we were walking over to the house on Sunday night, and I asked my boys. I said, "Boys, are you sad that Grandma and Grandpa are moving out of the house at all?" And no, there was like zero emotion out of it. And I'm walking over thinking to myself, "Am I upset by this?" And I think to myself, you know what? I was upset when they got rid of the phone number they've had since I was a child. Moving the house doesn't bother me at all.
No sentimental feelings there.
So,
you know why I'm a little bitter, right?
Why are you bitter?
Your parents did not invite me to the farewell party to the Kenilworth house. Pretty sure I had a big influence on that house growing up.
You did. Mostly what food came in and out of the house.
SpaghettiOs out of a can and video games for sure. Should I move on to the next slide, Josh? Compliance.
Yeah, please,
cool.
Please.
And then after compliance, I want to talk about coffee, but here we go.
That sounds good. As always, we'd like to remind you that what we're going through today is simply information. It is not advice. Advice has to apply specifically to your situation, and we'd be happy to provide you advice. Just let us know. So please don't take anything we're providing today as advice.
Perfect. And that makes Brian very happy. Today's coffee, Josh, is brought to us by the one and only Brew Point Coffee right down the street from us. This is their banana bread chai. It is just as good as the homemade banana bread that Brian just brought us. It is delicious. How about you?
I have a good old black coffee.
Yeah, well, you're boring. All right,
Yeah.
Obligatory cheers with a smile on the camera.
Cheers.
Perfect. That'll make good. All right. And let's see. Later in October, actually early October, October 4th and October 5th, Josh, we have our next set of Social Security workshops. We're hosting them at the Park District of the Grange. And these are great for those that have not heard you speak on this particular topic. But really, anybody is invited, and anybody is invited to bring a guest. And there's a link at the bottom, fsrwealth.com/ss, that will bring you to the sign-up form. Josh, anything else that you have to say about that?
No, it's you put it well. We also talk a lot about taxes in there. I think we've changed the name of the presentation to Social Security and taxes because it's so much tax talk. But as you said, it's a great spot for people who have not heard us before, or if you haven't heard us in a while, please come back and listen. There's some new stuff inside of there. So
Perfect. Really quick as a recap, what is Java with Josh? Why are we doing this? Java with Josh is a monthly live video show that we stream to Facebook and YouTube and our website. Oh, did I put it up on our? I did put up on our website. Thought I forgot. And it is just another way for Josh to get a relevant, topical, timely market update to retirees and those soon to retire, and another chance for you to see this smiling face.
for you to humanize me,
Yeah, humanize you. You love that word, by the way.
I do.
And our next Java with Josh is Wednesday, October 18th. We scheduled them out for the rest of the year. I'm pretty proud of us, actually.
We did. In fact, we scheduled them out for the rest of the year, and then we've changed the date on this one,
Yeah.
and I changed the date of the next one. I don't think you've even noticed that, but that was not our original date. So
It
yeah,
was the 11th.
yeah, it was, but we're now
Perfect.
on the 18th.
Okay, love it. Well, that's great. And then we're just marching right along here. This is not too formulaic, right? We're doing okay.
No, the one thing that's not in our notes
Yeah.
that I want to make sure we address is next week we're doing our first webinar. We'll talk about that at the end, but it is Thursday and Friday next week. The link for it will go into the recap email that we send out for this, but I'll talk about that at the end as we go through this.
Love it. Perfect. And here we go. I want you to give a quick little update on that.
Giving you the confidence to make retirement the best part of your life. This is something that we changed. This is our mission statement here at FSR. And we changed our mission statement a year ago from tax-focused retirement planning to giving you the confidence to make retirement the best part of your life. And most companies' mission statements that I've noticed become very, you write them and then you put them on a wall or you put them in a book and you never see them again. Well, this is something we truly live here and breathe, and we love when we get to help a retiree or anybody realize that this is the moment they've been looking forward to. This is the best part of their life, and if we can do anything to make that more of a reality for their specific situation, it makes all of us in this office feel unbelievably valuable.
So many warm and fuzzies this morning. I just feel so good about this.
Well, it's kind of
episode.
a rainy, dreary day outside, and we said, let's be warm and fuzzy.
You know what I usually do on these days? Sit home and watch Sleepy Hollow. But I'm here with you instead.
It's because I am human.
Oh my
and you're
God,
humanizing
here we go
me.
again. We did get a couple comments from people last episode, like, took too long to get to the good stuff. I'm like, all right, fair enough. But also you can watch the replay and skip ahead to the good stuff. So Josh and I just love talking. So we're going to talk a little bit before every episode, right?
Is that what we're doing?
Yeah, we're just bantering.
It's not just nervous energy that we're trying to get out?
No.
Okay.
What nervous energy. All right, Josh, you ready to start your presentation here?
Yeah, let's do this on today's Java with Josh. We've shown this on every single Java with Josh so far, and this is our Own Your Retirement Vision Visit planning process. And the sign behind it comes from this terminology. This comes from actually myself and my father. Growing up, we always were told to take control and ownership of your situation. And retirement is really the first time that anybody is able to take complete control of their financial situation. So the 5 areas that we show up there, those are the 5 areas that people have the ability to take control over. Today, we're going to talk specifically about investments and wealth creation and that component of it. And as we always say, just because you're retired doesn't mean you don't want to earn money anymore, but it also means that people think about it a little differently. And we have to make sure that we're not taking the same amount, or we're not thinking about the same way we were when we were working. So
Sure.
that's what we're going to spend some time talking about today. Now, as I go through this, the last few months, we've spent the whole time talking about interest rates and bonds and inflation and all that fun stuff. And as I was preparing for this, I said, we can't talk about that today. We're going to talk about stocks and equities because that's what people love to hear about. And for the most part, we are, but we couldn't get away from it completely. I am warning everybody, I have 2 repeat slides, and this is the first one that we have today because I want to make sure we're thinking about it from the right mindset. We are always trying to take emotion out of our investments as much as we can. And I think that sounds weird, with Dave trying to humanize me and with our mission statement of giving you the confidence to make retirement the best part of your life. Those are emotional thoughts. But when it comes towards this part of the own your retirement process, we really try and take emotion out of it as much as possible. So I showed this slide last month, and this is one of 2 repeats. And I want to go through this here. This is what we call our periodic table of investment returns, and every year there's a different best performer and worst performer. And so let's say at the end of 2008, you say, hey, I got some money I'm going to put in the market. And you look, what was the best performer in 2008? And the best performer was right here. It was U.S. Bonds. And you say, okay, this is great. Well, then all of a sudden in 2009, it becomes the worst performer. You're like, okay, well, it was the best year before. We'll hold out. Well, 2 years in a row, it's the second to worst performer out there. And you're like, all right, I'm out. I'm done. And the next year, guess what happens? Well, U.S. core bonds becomes the second best performer, and you jump back into it. And then we have 2 more years of it becoming in the bottom third, and it goes back up here. So you can see where I'm going with this. People make this mindset. They say, hey, I want to, how did it perform? They're looking at historical performance. They want to know, how did an investment perform? And what we tell everyone is you need to take the emotion out of it as best you can, because what truly matters is good diversification and that it applies to your specific plan. Now, today, I'm showing you some research from some big names out there. This is provided to us by Lincoln Financial Group. It's actually amazing stuff. It's all approved for client distribution too, which is fantastic. And every month they research some giant investment managers. And this is the investment managers at these different firms. These are some of the biggest firms in the market out there. So I want to show you what they think, because everyone says, what are they thinking and where are they going here? And this is one of my first things. And I focus up here on the equity section in the upper left. I'll explain this to you. Let's look at the U.S. large cap and what they're looking for the rest of this year, for the second half of this year. 43% of those money managers are bullish, meaning they think now's the time to put money into large cap equities. 21% think, no, this is not a time. They're actually selling off large cap equities. And 36% are neutral. Now, that seems like a big sway in the bullish side, but these are the best of the best, the smartest of the smart, and they can't come to an agreement on that. Now, if Dave and I were fighting over it, I'd hope you would listen to me as opposed to my good friend Dave. But these are not Dave and I fighting over it. Would you agree with that?
100%.
Dave's playing with like technical stuff over here. I'm watching him. It's like, it's like trying to sleep while your spouse like tosses and turns in bed all night.
I gotta put this up there. We got a comment from our buddy Clayton. He loves the sign.
Oh, Clay, I am glad you love it. Clayton nerds out with Dave and all this little stuff here. So more signs.
He says more signs, kind of like more cowbell. All right, Clayton, we're working on that, man. Thank you.
So what I was trying to show there is how all of these money managers, they all think different things. And even as we sit in our investment committee meetings, we were doing this yesterday as a team, there's so many good and bad things happening out there that there's a lot of unknowns. So let's keep going here. And this is a slide that I've showed variations on this throughout different times here. Sorry, let me pull that back up. This talks about how valuable the time in the market is. And what we're looking at here, this here is the S&P 500. And in any 1 year period of time from 1976 through the end of 2022, we've averaged 12.7%. That's our median as that comes into play. Now, the best year was up 61. The worst year was down 43. Now, let's stretch out here. Let's go to a 10-year period of time. Our average has dropped a little bit to 11.6 in the best 10 years. So this is the best 10 years. It's averaged 11.6, but the worst we've done over that 10-year period of time is we would be down 3.4% and we'd be up almost 20. Now we go out a little bit farther to 20 years. Our average comes down, our median comes down a little bit more. But now the worst we've done averaging over a 20-year period of time is 4.8. The most is 18.3. So what does this tell me? And what does it, what do I, when I'm trying to show this to you, what am I trying to show? That the volatility that we see by taking emotions out of the decision tree, then the longer we can hold on to it, the more likely we are to have guaranteed up results. Now, again, nothing's guaranteed. Don't worry, Brian. But the longer you hold on to something, the better off it's going to perform. So where do those emotions come into play? Now, as a retiree, the last thing you like is to see your positions fall here.
Dave relates to retirees. That's why I hold on to my figurines, because the value is going to rise.
Is that what it is?
Yeah.
Is that what it is?
Josh, maybe go like this distance from your little poppies. Maybe like this distance would be good. Yeah.
Better?
Much better. Thank you, sir.
God, I can't make these artsy people happy. Last month, they telling me I wasn't talking into the microphone.
Well, look, if we didn't do it, Clayton would throw us under the bus. So.
That's true.
All right, next slide.
And this one we've showed before too. This is if you had $10,000 in January of 2003, put it in the S&P 500, where would you be? And if you were invested every single day of 2000 from 2003 to the end of 2022, your $10,000 would have went up to almost $65,000. Big growth. But if you would have missed the 10 best days, now we've lost half of that. Now you've only earned up to almost $30,000. If we miss the 20 best days, so on and so forth. You know, if you miss the 40 best days, we're actually negative. We actually have lost money on this.
Wow.
So by making these knee-jerk reactions of trying to time the market and trying to get in and out of it, that is where we cause a lot of problems. And because the market does have big swings, it has big downswings, but it also has big upswings. So this emotion coming out is important. So I wanted to preface the rest of what we're going to talk about today with that preset, with that mindset shift, because I'm going to show you some good things and some bad things, and I don't want the mindset to go crazy on us.
We like to keep it positive.
We do on this dreary day. So last October was our latest low. You know, last year, 2022, was not a fun year for the equity markets or the bond markets. October was our low, and this is where we've come up from that point. So as you can see, our large cap stocks are up 36% from that point in time. Emerging market stocks are up 16%. So we're up big from last October. But there's a few things that we're watching right now. First off, inflation is kind of like my daughter's slime that she likes to make, and it sticks to our couches all over the place. Inflation has become sticky. It's stuck around here, and they announce the year-over-year inflation numbers towards the end of every month, and they just announced the August numbers. August came in a little bit higher than expected. It was expected at 3.6%. It came in at 3.7%. It's actually up over the prior month. And what kind of concerns us with this is that that is the second month in a row that inflation is up after 12 straight months of decline. They're not big ups, but it's up a little bit. And Dave, you're probably asking, why is he talking about that?
No, I'm asking, why can't you look at the camera, not the monitor? Because it's driving Brian crazy over
Well, I do things to drive you nuts.
Look at the camera. That's what I'm wondering. But no, actually, I am curious. Yeah. Why did it go up, Josh?
Well, I don't know why it went up, but actually I do. A lot of it has to do with energy prices, gas prices, and the like are a big component of inflation numbers, and those went up significantly. But why this bothers us and why we're worried about this is the fact that a lot of what the Federal Reserve is trying to do with raising interest rates has to do with these inflation numbers. So I said I wasn't going to talk too much about inflation or interest rates, but the next slide is all interest rates. And I've showed a variation of this slide pretty much every Java with Josh that I've done, and it's a very interesting slide. They update it every month, and this is the yield curve. So when we look out here, this is 20. This down here, this is our 2022 yield curve at February of 2022, and this is what we call a normal yield curve. The shorter term rates, the 3 months rates, are lower than the longer term rates, the 30-year rates. So, and that's normal because the longer you hold your money, the more risk it is, the higher interest rates can provide. And at the end of August, we were here. Our short-term rates, our 3-month rates, were actually almost 5.5%, where our 30-year rates were still down at 4.2%. Now, the Federal Reserve, the institution that sets the interest rates, and they're raising them because of the inflation. They set this is the 3-month. They set the 1-day rate, and so everything else is a market rate. The Federal Reserve doesn't set the 30-year rate, but it's based off of the earlier rates. Now, one of the things that we worry about this is they call this inverse yield curve because of the fact that the risk is out of whack. Sometimes they say this is a sign of a recession or something along those lines coming up. But we also had some good news recently. Last week, at the end of the week, the 10-year rate closed above 4.3%. That's a good change. We're seeing some longer term rates come up. Now it's come back down a little bit right now, but that's a good news that we're looking for as that comes out there. So I'm going to show you some more good news. It may seem a little weird. The S&P is way up, but it's still way off of its high in a lot of different sectors. So industrials and healthcare, information technology, those are pretty close to their high. They're still not to where they were at their high. But if you look down here, financials and utilities, these different sectors down here still have a lot of room for growth to get back to where their highs were. That's out there. So there's a lot of room for growth as that comes in. And at the same time, this blew me away as I was reading about this. The S&P 500, the 500 largest stocks in America, up through May of this year, we were up significantly through May of this year. 97% of that up came from the top 7 stocks in the S&P 500. So 7 stocks attributed to 97% of the growth. Isn't that crazy?
Yeah.
And then you fast forward there through June, now it's only 70%. So that means the rest of the S&P is starting to catch up. And through the end of August, it went up a little bit more. So that means the rest of the S&P is starting to rally at the same time. That's good news for investors. And said a different way, the white bar here, that is May. And if you look, the stocks that were down of the S&P 500 through May, over half of them were actually down through May.
Over half.
Over half. Isn't that crazy?
Oh, yeah.
And now we're under 200 that are down. So this is an interesting spot when you think about where the broader S&P 500 is and how much it's controlled by just a few equities. So that was the good news. I'm saying, hey, there's a lot of good that's happening out there. And now I want to show you some of the bad news. And I'm not going to lie, this slide emotionally scares me. This comes from that same money managers as they look at their different economic indicators that are out there. And they're showing what they looked like right before the last few recessions. So in 2021, the 07-09 recession. 2020 is an anomaly. 2020 was looking phenomenal. We just happened to have a pandemic come through us. So we kind of ignore that one a little bit. But this is where we sat at the end of July. Our economic indicators are not good. Like this is a sign that people are worried about. This is when you hear people being terrified of things. This is why we hear that. So I show you all these good things, and then we have this as well. And this kind of ties into that at the beginning, where all these money managers don't really know what to expect and where to go with it. So it's not set in stone as to say this is where we're going. Nobody has that crystal ball, no matter what they may tell you. They have emotions, they have feelings, but they don't have that crystal ball for it. So
Yes, that makes sense. So you're about to ask me, does that make sense, David? And I'm going
I
to just
love to
say,
ask,
yes,
does that make sense?
you do. It's your thing.
Yeah, as opposed to saying,
Whoa,
that's what I do.
can you find a more pixelated picture there, please?
Yeah,
Come
it looks
on.
really good when it was really tiny, but
Oh.
I Googled debt ceiling, and that's what I came up with.
Friends watching, this is what happens when Josh has not run the slides past me before going live.
So there's three things that we're really looking at right now in the short term. One is the debt ceiling. So the debt ceiling, if you remember, we had this issue with the government shutdown earlier in the year. They passed a short-term fix. Well, that's coming up for renewal right now. We don't know what's going to happen. I'm not really worried about it long-term, but people do get really concerned about it, and it causes a lot of panic and emotion in the market. So if we see a debt ceiling, we are not going to do panic selling here. That's not anything that we're worried about, but do realize that it has it will have some impact on the short-term market conditions there. The next is interest rates. We want to know what's going to go on with interest rates. As we sit here today, we're having this lovely conversation, you and I, but the Federal Reserve Board, which controls the short-term interest rates, is actually meeting right now. And
Right now?
right now, as we speak, right now. Legit, right now. Yeah, today and tomorrow. They're sitting down and they're going to decide if they're going to raise rates. Now, the market does not have a rate increase priced in today. They do think one might occur before the end of the year, but with inflation numbers as we saw, jobless numbers still aren't where they want them. And I said I wasn't going to talk about interest rates, but they are going to have a massive impact because when at some point in time they will stop raising rates, and when they do, that will be really good for the market. And so those interest rates are very sensitive, not just to the bond side, but also to the equity side.
They couldn't just let us have our moment. They had to have their meeting at the same time as Java with Josh.
They probably don't have a cool neon sign, though.
No, they definitely don't. Losers.
It'd be harder to humanize them, I believe.
Here we go
for you.
again. Oh my gosh.
And the last thing we're looking at is inflation. Inflation's a very real number. Inflation is going to be there. And I've said it before in prior episodes where back when I was in college in 2003, we learned about it, but we never really became a reality. Inflation is going to be a very real thing that we're going to have to make sure we're focusing on for people's retirement plans for the foreseeable future. So those are kind of what we're watching there. And I told you at the beginning, I have 2 repeat slides. And one of my favorite things that we did last month is we gave you actionable advice and said, hey, but we're not giving advice. We gave you actionable items. That's not advice. But to take away from this. And I said, well, I'm going to do that again this month. And I started writing the actionable items. And after I was done, I realized they were identical to last month. And so I said, I'm just going to use last month's slide. And here are my actionable items. First off, do not chase performance. That same thing I said before. We have to take emotion out of it, find a plan that we are comfortable with. You are going to spend your money. That's okay. It's there for you. We can put a plan in place that makes it where the volatility and the market performance doesn't impact what you can spend. Have a plan you're comfortable sticking with. Sticking to. You're not supposed to end sentences with to, I remember as a child. So I made this slide. This is that emotion side. Take the emotion out of it. Rebalance. Now is a time. If you are worried about risk, if you say, hey, I don't like this risk, now is the time to think about it. And the last one down there is take advantage of current market conditions. And that's always the case. Just because you're not trying to make knee-jerk reactions, there are current market conditions that you want to take advantage of. On the fixed income side, lock in rates for the longer term. Looking at alternative options. For example, right now, this is where I told you we're talking about this webinar. We're doing a webinar next week called Refinance Your Annuity. When interest rates are low, you refinance your mortgage. When interest rates are high, you refinance your annuity. Love or hate your annuity, if you own one right now. The vehicles that exist today didn't exist 2 years ago. This is simply one of the best times I've ever seen in history. If you do have an annuity in your portfolio, to look and see if you can do something better with it, or if you don't have one, now may be the time that you actually want it. And we're not annuity pushers in any way, shape, or form, but if they fit into your plan, you need to look and see, do you have the best one? Because this is the time for it. So I talk about that webinar we're doing next week. That is where that kind of fits in there, and that will be in the email recap. And if you didn't get it, please just comment below this video, and we'll make sure we get you the sign up for that.
Yeah, actually go to javawithjosh.com, enter your email address. That way we have your email address.
Yeah, I didn't ask him how to do that. I just said comment, and I really didn't mean it there. So
can't see people's email address on YouTube.
Oh man,
Facebook,
I'm sorry.
Yeah. Ooh, catch your breath. Good job, Josh.
I told myself I was going to talk slower this time, and I looked down at the clock and I said, "Whoa, I've been talking a lot."
Oh, we're good. We're like about 25 minutes of presentation. It's right on track. How do you feel about doing a little live Q&A?
We got some Q&As today?
Got some Q&As today. We
All
got a few.
right, let's see it.
We got a few. I think, Brian, I think I might write a jingle for our live Q&A. What do you think? Think we need one?
Are you going to sing it too?
I could do it live every time if you want. You know I'm not afraid to do that. All right. So we actually just had one come in from our buddy Clayton, actually. I actually like this one. Can you see it? I can probably make it a little bit bigger here.
What if you are not at retiring age? What are the tips to help save with inflation? That's actually a great question. And I'm surprised, Clayton. I'm sorry. But what happens is you want to think about assets that benefit in an inflationary time. And so there's things that you want to own. So they're physical assets. So if you are trying to buy a house, now is a great time to buy versus rent because you're going to see physical appreciation of that house. Equities are a great spot to be in most inflationary times. So if you're young and not retiring, now is a time. If you saw that graph before, if you have enough time that you don't need to spend that money, a straight S&P 500 type investment could be very valuable. So look for situations. Debt is not something we look at in inflationary times. You don't want people to owe you money because they're paying you back with cheaper dollars. So things like that, look for equities, look for things that you can own and control. So I hope that helps.
Excellent. I'm sure it does. Hey, I took that off. Get off the screen. Okay. We have one from our buddy, Leslie.
Leslie, I miss you. I haven't talked to you in so long.
I miss you more, Leslie. All right. And simple question. She's looking for updates on smart moves, not dumb moves, smart moves in the current investment climate, ! And she's a writer, so she knows punctuation.
She does.
Yeah.
It's true. Yeah.
Mm-hmm.
So I saw this question come in when you sent your email out, and I'm trying to think in my head, how am I going to answer this? What am I going to go with? And having gone through the presentation now, I think the absolute best way to answer this is it applies to your situation. So when you ask a question for smart moves depend upon where you are. So how I answered Clay's question before that regarding long-term equities and buying buying real estate may not apply to your situation. And with your situation, maybe we're looking at accumulating, the short-term rates where they are. How can we utilize those short-term rates to benefit you over the next 5 to 10 years so that we can let the equity performance take over there? So that's kind of what we look at with that. So it's very specific to your situation there.
You used my notes on that, didn't you? I wrote notes to her question.
Did you?
Yeah, you took my notes verbatim. Nice. That's great.
Yeah, go ahead.
Read the whole thing?
Yeah, so our good friend Mike F. sent in a story that he wants us to read here. So
yeah, this is actually good. Mike F. is top 10 podcast fan.
Yeah, he listens quite a bit.
All right, Mike F., I'm curious if you might find this interesting. UPS recently signed a 4-year contract with their drivers. By the final year, the compensation package is estimated to be valued at $171,000 a year. That includes wages, OT, health and vacation benefits, and a company-sponsored pension plan. Pensions are still around. UPS stated they will contribute over $23,000 per year towards their full-time employees' retirement. To Mike, that's fantastic. He's asking, Josh, can you crunch some numbers to estimate how much a long-time employee might expect at his or her retirement?
Well, it can be a little difficult, but what I went through was just that $23,000 a year being contributed. And over long term, let's say it's 30 years, at 6%, it comes to over $1.8 million. Well, that's a big deal. That's a lot of money that's being put away. And the reason I said yes, that I said, I want to read Mike's book here on the job with Josh, had to do with the fact that there's other things going on in the economy right now, similar to this. The UAW is striking as we speak for the first time with all three automakers, and they had to have saw what UPS agreed to. And what does that mean? Well, UAW at some point they will come to an agreement with the automakers. They will get increases in their wages. But that doesn't, that's not going to come out of the pockets of the big automakers. They're just going to raise auto prices. And so it essentially comes out of all of our pockets and it goes to the inflationary part of it. I'm not saying it's bad because those guys deserve to be paid, but don't think that it's not going to impact you on a day-to-day basis. And inflation's real. It's there. So far this year, one of the good things we've also seen is we've seen wages increase faster than the rate of inflation. So that means that there's been some consumer control over price increases a little bit, but that could go out the window again really quickly.
Good stuff. Mike, if you need clarification, don't email me. You can email Josh or Aaron or Sean or Brian or Chuck, anybody but me. Good. Last question comes from checking my notes. Oh no, it's from Bex, my mom. I need to do my voice. David, are we ever getting a new Retirement Equals Freedom podcast episode? I miss them. I think what she's asking is what millions of people are wondering is what the heck is up with our podcast? Because if you go on Apple Podcasts, it says show may be finished or on a break. And that scared the poop out of me because we're not finished. In fact, we're revamping it. Are we not?
You have a great, your imitation of your mother has not changed since we were kids, which is great. Yeah.
Yep.
We were really good at doing 2 podcasts a month. And all of a sudden you notice we have like a 3-month gap in this.
A little over about 2 actually now.
It'll probably be 3 by the time we get it all back. But we've wanted to kind of revamp them and make them more user friendly and make them more beneficial to the people that are listening to them. And we wanted to rethink how we did them. So they are coming back. It's just a matter of making sure we do it in the best way possible. There.
Yeah, I think I like to explain it. We're gonna button them up. We're gonna polish them so they deliver maximum impact.
And humanize Josh.
Oh God! All right. You want to talk about this here, Josh? Here. Or you want me to talk about
what?
That?
Would you talk about that?
Yeah. So I think essentially what we kind of end every episode with is anything you hear today from Josh, not me. If you have questions, if you're feeling uncomfortable, please book a complimentary 15-minute phone call with this guy right here. There will be, if you're on the javawithjosh.com page, there's buttons all over it saying book a complimentary call or book your call. If not, there'll be a button in the replay email. Pretty much anywhere you see our stuff, there'll be a button for you to schedule a call with Mr. Brettel over here. And if you're not, most of you, I think, are signed up for the Java with Josh email club, javawithjosh.com. Enter your email address, and you will be notified of when our new shows are going live.
October 18th.
October 18th. Yep. Java with Java. Oh, yeah. You could even go fsrwealth.com/Java. So cool. But I think when I have the camera like this, what you don't know what I'm doing, I'm actually taking notes.
Oh, you learned something today?
I'm taking notes. I just kind of bullet point. I recap in my own little words about what this episode is about.
I'm dying to hear what you learned today.
So I wrote, essentially, young viewers, we are in unique times with interest rates where they are and what the Fed is doing with them. Is that a pretty good?
Yeah, you've listened to the last 5 Java, Josh, as
perfect.
it says.
Yep. Mm-hmm. And this is just, I like, this speaks to me. Retirees should not make rash decisions, not like cream rash, like on your skin, but like
make those decisions.
Yeah, make rash decisions, but should definitely take advantage of the current market situation. How do I do?
Well, that's pretty good.
Thank
I like
you.
that. And there's a lot of unknowns out there. There's both good and there's bad, and we want to be prepared for both of them.
Mm-hmm. Absolutely.
So.
Al?
Oh, yeah. I do want to wrap with one last story. I'm really proud of my son, Alex. Alex has decided to run for his student council treasurer position. This is Allie's 9 years old in 4th grade. And my friends way back when thought I was going to run for political office, and they created a slogan. They called it "Settle with Brettle," or "Settle for Brettle" was their slogan, which sounds great. And so my wife, being the genius that she is, reframed that into "Don't settle, vote for Brettle." And this is Alex with his campaign poster that it's out there. So he's very excited. I'll have an update next time if he wins the treasurer position or not, but he's pretty excited.
I love that you guys desecrated $100 bills just for the sake of a political campaign
I'm
poster.
pretty sure those were not real $100 bills.
I'm pretty sure that's probably true. All right, so let's close this out. Again, our next Java with Josh is going to be October 18th. Yep, and again, go to javawithjosh.com, get your email address in there, book a 15-minute call with my buddy here, Mr. Brettle. And you buying lunch today?
Settle for Brettle. Yeah, why not? Let's eat.
Let's eat. Cool. Sushi?
We'll see about that.
Hey, Brian, when we slap hands, turn that sign off, buddy. Ready? 1, 2, 3.